Namaste. It gives me immense pleasure to meet you again in this video where I would be discussing 5 useful practical decisions in income tax. You all know income tax is a very dynamic law which keeps on changing now and then. Annually, the finance bill presented in the parliament brings some changes to the income tax law. Besides that, court decisions interpreting the words and expressions also contribute to the usage or the practical application of income tax law. Now, the first decision is about section 14A. You all know section 14A is a section for disallowing an expenditure incurred for earning exempt income. So, when an exempt income is earned and some expenditure is incurred, such expenditure is not to be allowed as deduction against other taxable incomes. Now, a question arises where the assessee has no exempt income at all, then whether he can claim those expenditures. There was some controversy. The Finance Act 22 inserted explanation to section 14A whereby whether the assessee has earned income from under the exempt head or has not earned income or even incurred loss, expenditures attributable to such source of income is not eligible for deduction. The most important thing is the explanation uses the word for removal of doubts. So once this expression is used, we tend to presume that it is clarificatory in nature, therefore it is retrospectively applicable. This has been clarified by the Delhi High Court in the case of Principal CIT versus ERA Infrastructure India Limited in 2022 Tax Pub DT 4907, saying that even in spite of the usage of the expression for the removal of doubts, the explanation to section 14A is not to be presumed as retrospectively applicable. Secondly, very practical, expenditures for which no tax is deducted at source is liable for disallowance. The disallowance is 30%. Only when the expenditure is claimed that disallowance can happen. How an expenditure would be claimed? Either by debiting to profit and loss account or by claiming it as an deduction, though not through profit and loss account, a deduction could be claimed. So, the Calcutta High Court in Principal CIT versus Linde India Limited, also a decision reported in the year 2022, Tax Pub DT 5979, where it has been held only when the expenditure is claimed as a deduction by debit to profit and loss account, or when it is deducted while computing the income under the head profits and gains of business or profession, this has to be disallowed, not otherwise. For example, an assessee incurs an expenditure, say brokerage 20,000. He has not deducted tax at source. If he is debiting his capital account or if he is not claiming it as expenditure, then disallowance will not apply. The third one is a very important one, New Noble Educational Society versus CCIT, again relating to the year 2022, Tax Pub DT 6798. We all know educational institutions existing solely for education is eligible for tax concession. I visualize 3 instances. One where the educational institution is a micro institution with less than 5 crore as aggregate annual receipt, which is fully exempt because of section 1023C subclause 3AD. The second one is educational institutions coming under the umbrella of charitable trust registered under section 12AB. The third one is educational institution solely for education which has obtained approval under section 1023C subclause 6. Now the controversy is with regard to this section 1023C subclause 6, where an educational institution seeking approval for tax exemption. Here the word used in this subclause is solely for education. Therefore, an educational institution which is existing solely for education could only obtain approval under section 1023C subclause 6. Therefore, the Supreme Court in this case, New Noble Educational Society versus CCIT, has held that such of those educational institutions have to obtain approval and they have to exist only for education. They should not have any other objects. That is a very important condition. The word used is solely. The meaning of the word solely means only or exclusively, or you can say in exclusion of other objects, all other objects. The Supreme Court held that these institutions have to change their trust deed or memorandum or bylaws, accordingly the objects clause, to ensure that they have only education as their sole object and they should not have any other objective. However, educational institutions existing solely for education may carry out activities which are incidental to education, such as sale of textbook, running motor buses for picking up students from home and dropping them back, then running a hostel for students only, then conducting summer camps to make the students have some multifarious talent like computer operation or web designing, like that. So these incidental objects they can have, but they should not have any other objects. But the Supreme Court, while giving this judgment, wanted to ensure that this judgment does not disrupt the existing institutions under section 1023C subclause 6. Accordingly, it has held that this decision is prospectively applicable and institutions seeking approval under section 1023C subclause 6 have to amend their trust deed and bylaws so that when they go for approval subsequently, it will be in accordance with this decision. This is the third decision. The fourth one is about books of account. There is always a controversy whether loose sheets of paper found in the premises of the assessee could be treated as books of account. The Karnataka High Court in Sunil Kumar Sharma versus Deputy CIT, Tax Pub DT 5834 is the citation, has held that books of account means something which is regularly maintained. Loose sheets of paper or scraps of paper, even if it contains some information, cannot be treated as books of account because they are easily detachable and can be replaced. So we should not consider loose sheets of paper as books of account in the context of seizure of books of account. This is decision number 4. The final one is about section 201 subsection 1, treating the assessee as assessee in default for failure to deduct tax at source. The time limit is extended from 2 years to 7 years by the Finance Number 2 Act 2014. Whether this extended time limit would apply retrospectively or only prospectively was the matter of dispute in CIT versus Acer India Private Limited, Tax Pub DT 1033, where the Karnataka High Court has held that this amendment is only prospectively applicable. The extended time limit cannot be applied for the earlier years. This is a very important one. For example, for the assessment year 10-11, they cannot say 7 years would expire only by 17-18. So these are the 5 decisions. I thought I would just give it in the form of a capsule. To recapitulate, the first decision is about explanation to section 14A, saying that the explanation is prospectively applicable and in spite of the expression for the removal of doubts. The second decision, section 40A, that is 40A1 and 40A1A, meant for disallowance of expenditure when tax is not deducted at source, only when such expenditure is claimed as debit to profit and loss account or it is deducted while computing income and other profits and gains from business or profession. In the case of PCIT versus Linde India Limited. The third one is very important, significant decision, Supreme Court decision, where institutions existing solely for education seeking approval under section 1023C subclass 6 have to necessarily obtain approval by amending the trust deed with education as its sole object and should not have mixed up objects. The fourth one is what is books of account. Loose sheets of paper or scraps of paper should not be treated as books of account. Books of account means something which is regularly maintained. The last one is limitation for imposing penalty under section 201 subsection 1, for which the extended time period of 7 years by the Finance number 2 Act 2014 will apply prospectively and it will not apply retrospectively. So these are the 5 decisions which I thought I will give it in a capsule form for easy assimilation by all of you. Thanks for watching the video. Thank you.